Welcome back to BullionIQ, everyone. I hope you're having a fantastic day wherever you are. Today, we're diving into some extremely exciting news in the crypto world, and specifically, we're going to focus on XRP. You know, I always try to bring you the real insights as a crypto expert, not just headlines. So, if you're curious about what's really happening behind the scenes with XRP, stick around because this story will completely change how you think about this digital asset. Let's start with a fascinating story that caught my attention. Jay Claver recently highlighted how ultra-high net worth individuals are beginning to enter the crypto market, and XRP is one of their key targets. Keep this in mind, over 99% of the world doesn't own any XRP at all. That means as more people, potentially 100 to 200 million over the next few years, enter the digital asset space, the demand for XRP could be massive. But to understand why this matters, let's go back to a story Jay shared. He tells us about a friend whose cousin works as an Uber driver. One day, this cousin picked up a family that clearly had wealth just by noticing the way they carried themselves and the clothes they wore. While driving them, he heard them talk about their investments, and it turns out they hold a substantial amount of XRP. This is not a random family. They are tied to a well-known brand you've probably interacted with in your life. The key takeaway here is that high net worth families are slowly waking up to the potential of XRP as a serious asset. Now let's put some numbers on this. There are roughly 7 to 8 million XRP wallets on the ledger today. Yes, millions might sound like a lot, but there are 8 billion people on the planet. That means well under 1% of the world's population actually owns XRP. Bitcoin has a much wider reach, but XRP remains scarce among everyday people. And here's something even more interesting. About half of these wallets hold less than 100 XRP. That's not a huge amount of exposure. What makes this so fascinating is the mindset of the people entering now. Many of these high net worth investors are not looking to gamble. Their goal is wealth preservation and capital protection. They understand that risk is real, especially in the crypto market, which many still view as the Wild West. In fact, around 62% of family offices have no allocation toward crypto, while the remaining 38%, out of trillions of dollars globally, are carefully considering small strategic investments. These aren't reckless bets. They're hedges against bigger risks in traditional markets. Think of wealth like a tree. The core investment, your trunk, is what you focus on growing steadily. Over time, branches spread out, representing diversification into other assets. If one branch fails, your trunk, your core wealth, remains strong. This is exactly how these high net worth investors approach crypto. They aren't dumping billions into XRP. They're adding strategic branches to their portfolio to protect against inflation, stock market dips, or potential instability in bonds. XRP is simply one of the tools in that hedge. And here's the real kicker. Even though only a tiny fraction of the population owns XRP, the impact could be massive as adoption increases. Estimates suggest that maybe 2 to 3 million people truly hold XRP when factoring in multiple wallets per person. That's still well under 0.01% of the global population. In other words, most people don't have access to these assets yet, which makes those who do extremely well positioned to benefit from the next wave of adoption. Ripple has been quietly building what they call the Internet of Value since day one, and the momentum we're seeing now is genuinely exciting. One of the key highlights is RippleNet, which is Ripple's enterprise blockchain network for cross-border payments. This technology allows transactions to happen almost instantly across borders, something traditional banking systems have struggled with for decades. Recently, Ripple announced that CIMB, the second largest bank in Malaysia and the fifth largest Southeast Asian bank, joined RippleNet. They're going live with a new remittance service called Speed Send, initially facilitating payments from Malaysia to Australia. This may sound like a small step, but it's actually a huge indicator of how quickly Ripple's technology is being adopted in real-world financial systems. With these partnerships, Ripple isn't just focused on speculative trading. They're creating infrastructure that will allow digital assets like XRP to move seamlessly across borders, making them practical for global commerce. Another notable partnership is with RedUpPay, a fintech company that leverages stablecoins for international payments. They've integrated Ripple's cross-border solutions to enable users to send crypto and receive NGN, the Nigerian currency, in minutes. Traditionally, remittances can take days and incur fees of 5.07%, which is a major pain point in emerging markets. With Ripple-powered infrastructure, this process becomes near instant and significantly cheaper. For Ripple and XRP, this is huge because it positions the blockchain as a serious alternative to traditional financial rails. The demand for these services is growing rapidly, particularly in the Asia-Pacific region, which is currently seeing the fastest growth for on-chain stablecoin activity. Institutional adoption is another crucial factor. Large family offices, banks, and asset managers are beginning to allocate small percentages of their portfolios to digital assets like XRP. It's important to understand their mindset. These institutions are not looking for explosive gains overnight. Instead, they view XRP and other crypto assets as a hedge against macroeconomic risks, such as market corrections, inflation, or the unwinding of the carry trade. These are sophisticated investors who understand risk management, and their involvement adds legitimacy to XRP as an asset class. Speaking of the carry trade, this is one of the reasons why we're seeing growing interest in crypto. Many high-net-worth individuals and institutional investors are concerned about potential losses from global market shifts. By adding XRP to their portfolios, they're essentially creating a diversification strategy. Remember the tree analogy from Part 1. The trunk is your core wealth, and the branches are your diversified assets. XRP becomes one of those branches, a hedge against volatility elsewhere. The numbers around XRP adoption are still very interesting. There are roughly 7 to 8 million XRP ledger accounts, but due to multiple wallets per person and custodial accounts held on exchanges, the actual number of people owning XRP is likely closer to 2 to 3 million. That's still less than 0.01% of the global population, meaning over 99% of people don't yet own XRP. This scarcity, combined with real-world adoption through RippleNet and partnerships like CIMB and RedUpPay, could create a perfect storm for price appreciation and mainstream recognition in the coming years. Another important aspect is Ripple escrow and liquidity management. Over the past few years, Ripple has been systematically unlocking and relocking billions of XRP. This controlled release strategy ensures that the supply of XRP in circulation grows in a predictable and sustainable manner. Reports show that about 30% of XRP is actively being used, with the rest stored securely. This strategy maintains scarcity while supporting liquidity for enterprise use cases. Understanding this mechanism is critical for anyone analyzing XRP's future potential because it shows deliberate planning behind supply and demand. Now let's also talk about the global financial ecosystem. Ripple's technology is attracting attention from some of the largest financial institutions worldwide. During events like the Ondo Summit, major players such as Citi, JP Morgan, Fidelity, Invesco, and even consulting firms like McKinsey discuss innovations in tokenization and blockchain infrastructure. These institutions are not just exploring crypto, they're actively integrating these solutions into the broader financial system. XRP, being a bridge asset for cross-border settlements, sits at the center of this evolving network. In Europe, we're also seeing banks collaborate to launch euro-backed stablecoins. 10 major banks, including ING, UniCredit, and BNP Paribas, have formed an Amsterdam-based company to issue fully regulated euro stablecoins. While this isn't XRP, it signals a broader trend. Banks understand that if they don't adapt, fintech innovators and blockchain projects like Ripple will disrupt the financial system. This push from banks ultimately complements XRP's adoption because it validates the concept of digital assets as mainstream financial tools. Let's not forget the Nigerian market. Through RedUpPay's integration, users can send crypto and receive local currency within minutes. This is not just a technological achievement, it's a shift in financial inclusion. Many people in emerging markets are underserved by traditional banks, and XRP-based solutions offer them fast, cheap, and reliable access to global financial systems. As these services expand, XRP will increasingly become a key tool for everyday cross-border transactions. Finally, Ripple's expansion strategy is working on multiple fronts: enterprise adoption through RippleNet, partnerships with banks and fintechs, and institutional interest from family offices and investment firms. These developments show that XRP isn't just a speculative asset, it's a utility token with real-world applications that are growing every day. And as adoption spreads, the scarcity we discussed in Part 1 could lead to a significant increase in demand, potentially driving both price and network usage. Now that we've explored Ripple's partnerships and adoption, it's time to take a closer look at XRP ledger growth and wallets, because these numbers tell a story about how XRP is being accumulated and used around the world. The XRP ledger is still surprisingly small compared to other major cryptocurrencies. As of mid-2025, there are roughly 7 to 8 million wallets, but the number of real people owning XRP is significantly lower, probably around 2 to 3 million. This is because many individuals and institutions hold multiple wallets across exchanges, custodial services, and personal storage. It's a detail that most casual investors overlook, but it's extremely important when thinking about scarcity and future price action. Let's break this down. About half of these wallets hold less than 100 XRP, which is not a huge amount in terms of market influence. Then you have a small subset of around 100,000 wallets holding at least 10,000 XRP, which represents the more influential holders who can impact market dynamics. These wallets often belong to exchanges, family offices, and early adopters who have been accumulating XRP for years. Understanding this distribution is crucial because it shows that while XRP is technically available, a significant portion of it is concentrated in the hands of a few entities. This is why even small shifts in institutional allocation can have an outsized effect on the market. Recent reports indicate that the XRP ledger has grown steadily throughout 2025. From 6.28 million wallets at the start of the year to about 7.12 million by mid-year, we've seen consistent activity, with bursts of tens of thousands of new wallets in short windows. This shows both retail and institutional interest expanding. These numbers don't just represent holders, they represent participation in the XRP network, which is vital for its long-term health. The more wallets and users actively engaging, the stronger the ecosystem becomes, reinforcing Ripple's vision of a global digital financial infrastructure. It's also important to understand the on-chain versus off-chain dynamic. Many wallets are custodial, meaning exchanges and banks control multiple individual accounts through a single on-chain address. For example, an exchange like Coinbase could manage tens of thousands of users but only show up as one on-chain wallet. This means the actual adoption among people is far greater than the raw ledger numbers suggest. When you combine this with the growing institutional allocations we discussed in Part 2, you start to see a network that is quietly but steadily expanding, laying the foundation for broader financial adoption. Let's talk about wealth preservation and risk mindset, which ties into wallet ownership. High net worth individuals entering the XRP market aren't there to gamble. They're focused on preserving capital and hedging against global market risks. This is a key difference between early adopters and newcomers. Early retail investors often focus on short-term gains, while these sophisticated investors treat XRP as a strategic asset. That's why we see a significant number of wallets holding substantial amounts but not actively trading. These investors are in it for the long-term utility and hedge potential, not just speculative profit. This brings us to the impact of scarcity on the XRP market. With roughly 2 to 3 million people controlling the majority of XRP, it's a tiny fraction of the world's population, well under 0.01%. That's staggering when you consider that the global population is around 8 billion. Most people simply don't have access to XRP yet, which sets the stage for what could happen as more investors enter the space. Imagine if another 100 million people decide to diversify into digital assets over the next few years. What will that do to XRP's remaining supply? The potential demand shock could be enormous, especially since so much XRP is already concentrated in a limited number of wallets. Another factor to consider is Ripple's escrow and controlled supply releases. Over the years, Ripple has unlocked billions of XRP, but only a portion of that is actively in circulation. Most of it is relocked in escrow, ensuring that supply grows predictably without flooding the market. Reports suggest that only about 30% of XRP is actively used for transactions, with the rest securely held. This strategy ensures that the market isn't oversupplied while still supporting enterprise use cases like cross-border payments. For investors, this creates a favorable environment, limited active supply combined with growing adoption and network utility. Let's dive into some practical implications of wallet distribution. If we assume 2 million active holders, each owning an average of 3 to 4 wallets, that accounts for a significant portion of the XRP ledger. This means the actual adoption base is small, but highly strategic. Early movers and institutional holders are positioning themselves for long-term growth, which reduces the risk of sudden mass sell-offs that could destabilize the market. At the same time, new entrants entering XRP will likely compete for the limited available supply, driving both network usage and potentially higher prices. The growth of XRP wallets also correlates with institutional adoption trends. Family offices, banks, and fintechs are gradually entering the market, often in smaller calculated allocations. They are treating XRP not as a speculative play, but as a tool for wealth preservation, cross-border payments, and hedging against global market volatility. This is a significant development because it brings legitimacy and stability to the XRP market. Over time, as these institutions expand their allocations, we could see a gradual shift in market dynamics, with XRP increasingly recognized as a strategic digital asset. Finally, let's consider the future growth potential. Even with just a few million holders today, XRP has already proven its utility in cross-border payments, remittances, and enterprise applications. As awareness spreads and more people, from retail investors to institutional players, gain access, the number of wallets and the volume of transactions will likely accelerate. This isn't just speculation. It's supported by ongoing reports of ledger growth, new wallets being created, and real-world adoption via partnerships like CIMB and RedUpPay. The combination of scarcity, institutional involvement, and growing utility makes XRP one of the most compelling digital assets for the next phase of the crypto revolution. Now that we've analyzed XRP wallets and ledger growth, it's time to zoom out and look at the macro picture. Understanding global financial trends is critical for any serious crypto investor because digital assets don't exist in isolation. They interact with traditional markets, central banks, and institutional flows. One key factor right now is the carry trade. For those unfamiliar, a carry trade involves borrowing money at a low interest rate and investing it in higher yielding assets. Over the past few years, this has been a major driver of equity and bond market movements. But as global interest rates shift, these trades are unwinding, and that has implications for crypto, including XRP. Many high net worth individuals and family offices are watching this closely. They are concerned about a potential unwind of the reverse carry trade, which could put downward pressure on traditional markets. This is where XRP and other digital assets come in as uncorrelated hedges. Unlike equities or bonds, XRP operates on a global decentralized ledger. Its price and utility aren't directly tied to the same risk factors as traditional markets. For wealthy investors, this makes XRP an attractive option to protect capital against potential shocks in stocks, bonds, and fiat currencies. This dovetails perfectly with the current stance of central banks, especially the Federal Reserve. Most analysts expect the Fed to cut rates towards the end of the year, potentially by 0.25% to 0.50%. Cheaper borrowing costs generally encourage investors to take on more risk, whether in equities, real estate, or digital assets. If the Fed lowers rates, it could act as a tailwind for crypto adoption, especially for assets like XRP that already have strong enterprise use cases. Investors tend to look for assets that can preserve value and deliver growth, and XRP ticks both boxes when you consider its limited supply and growing global infrastructure. Another point worth highlighting is how wealthy individuals approach risk. Unlike retail investors chasing short-term gains, these participants are focused on capital preservation. They don't throw billions into a single digital asset. Instead, they allocate strategically. XRP, Bitcoin, stablecoins, and other tokenized assets become parts of a diversified portfolio, similar to branches on a tree. This strategy ensures that if one asset underperforms, the overall portfolio remains intact. It's a mindset that sets apart serious crypto investors from casual traders and explains why XRP adoption among institutions is measured but deliberate. The recent crypto sell-offs and corrections, such as those in November 2025, highlight the importance of this mindset. Many people panic when prices dip, but in reality, these dips often present buying opportunities for disciplined investors. Analysts at HSBC and other major institutions have described the current market as a buy signal rather than a sell signal, emphasizing that short-term volatility is normal and shouldn't overshadow the long-term adoption trends we're seeing with Ripple and XRP. Now let's connect this macro perspective with Ripple's partnerships and real-world adoption. Institutions and fintechs are not just looking at XRP as an investment, they're using it to solve real financial problems. For instance, CIMB in Malaysia has joined RippleNet, enabling faster, cheaper cross-border remittances. Similarly, RedUpPay in Nigeria is integrating XRP and stablecoins to facilitate near-instant local currency payouts. These developments show that XRP is not merely speculative, it's becoming a practical tool for global finance, which further reinforces its value proposition to institutional investors. Consider the implications of tokenized central bank initiatives. 10 European banks are planning to launch a euro-backed stablecoin fully regulated and compatible with blockchain networks. While this may seem like competition, it actually validates the space. When traditional banks adopt tokenized solutions, it demonstrates that blockchain technology and XRP's model of fast, low-cost transactions is increasingly essential for global finance. This broader trend creates a supportive backdrop for XRP, especially for investors looking to hedge risk and gain exposure to digital infrastructure. It's also worth noting the scale of financial institutions entering crypto discussions. Events like the Ondo Summit bring together major players: Citi, JP Morgan, Fidelity, Goldman Sachs, and many others. These institutions collectively manage trillions of dollars and are actively evaluating crypto for settlement, custody, and cross-border payments. For XRP, this is huge. Every strategic partnership, enterprise integration, or fintech adoption increases network utility and signals growing institutional confidence. Unlike early speculative booms, this adoption is methodical and aligned with long-term capital preservation strategies. One of the most compelling points for investors is the unprecedented scarcity of XRP relative to potential demand. With only 2-3 million holders globally and most of the supply held in escrow or strategic wallets, even moderate adoption by institutional investors can create supply pressure. Combine that with macro factors like Fed rate cuts, potential market corrections, and carry trade unwinds, and you start to see why XRP is becoming a preferred hedge for sophisticated investors. It's not about getting rich fast, it's about wealth preservation and strategic positioning. Finally, let's touch on market psychology and long-term trends. As more people, from retail investors to institutional participants, understand XRP's utility and scarcity, the adoption curve will accelerate. Early movers like family offices and fintechs are setting the stage for broader mainstream awareness. The combination of low supply, institutional trust, real-world applications, and macroeconomic catalysts makes XRP a standout digital asset in the evolving financial ecosystem. Investors who understand this can position themselves advantageously, not just for price appreciation, but for long-term network value and utility. Let's talk about the future of XRP, tokenization, and the broader financial ecosystem. One of the most important trends shaping the next decade is the tokenization of assets. Simply put, tokenization is turning real-world assets like cash, stocks, bonds, or even property into digital tokens that exist on a blockchain. XRP is uniquely positioned to benefit from this because it already operates on a fast, scalable, and secure ledger that can handle millions of transactions per second. This means it's not just a speculative asset, it's part of the infrastructure that could redefine global finance. Institutions and fintechs are beginning to understand that tokenized finance can dramatically reduce costs, speed up transactions, and improve transparency. For example, cross-border payments today are often slow and expensive, taking 1 to 5 business days with fees around 6 to 7%. XRP enables near-instant settlement with extremely low costs, making it attractive for banks, payment providers, and remittance companies. As more institutions adopt these solutions, XRP becomes more than just a token. It becomes a utility asset embedded in the global financial system. Looking at the numbers, the potential growth is staggering. There are 8 billion people on the planet, yet only about 2 to 3 million individuals hold XRP. That's less than 0.01% of the world's population. When we consider the coming years, even modest adoption could mean hundreds of millions of new participants entering the digital asset ecosystem. Imagine what happens when traditional financial institutions, large family offices, and high net worth individuals all start allocating even a small portion of their assets to XRP. The supply is limited, adoption is accelerating, and the infrastructure is already in place to handle this massive influx. Another key aspect is the role of Escrow and XRP's controlled supply. Ripple has consistently managed XRP through escrow mechanisms, unlocking small portions for operational and strategic purposes while relocking the rest. This ensures predictable supply growth, which reduces the risk of sudden market dumps and supports price stability over the long term. When combined with real-world adoption through RippleNet partnerships, such as CIMB in Malaysia and RedUpPay in Nigeria, XRP's value proposition becomes extremely compelling for both retail and institutional investors. We also need to consider the geopolitical and macroeconomic factors shaping adoption. Central banks are exploring their own digital currencies, and European banks are planning euro-backed stablecoins by 2026. This doesn't compete with XRP directly. Rather, it validates the broader blockchain ecosystem. Governments and banks are recognizing that digital assets are here to stay, and they want a piece of the infrastructure. XRP, already integrated with global payment rails and fintech applications, stands to benefit from this evolution. Now, let's address the mindset for investors. One of the biggest mistakes in crypto is chasing hype without understanding utility and adoption trends. The wealthy and institutional players entering XRP are doing so with a long-term strategy: wealth preservation, strategic exposure, and network utility. They are not chasing short-term pumps. They are positioning themselves in an emerging global payment system that can handle trillions of dollars in value every year. For everyday investors, the lesson is clear. Understand the technology, the real-world use cases, and the macro context before committing significant capital. It's also worth highlighting the network effects. XRP's growing adoption by banks, fintechs, and payment providers creates a positive feedback loop. Each new partnership increases the ledger's utility, which attracts more participants, which in turn encourages even more partnerships. Over time, this can lead to exponential growth in transaction volume and adoption, making XRP not just a speculative asset, but a core part of the global financial infrastructure. Looking forward, there are several catalysts to watch. First, regulatory clarity will play a big role. XRP has faced legal scrutiny in the past, but as regulations around digital assets become clearer, more institutional players will feel comfortable increasing allocations. Second, technological innovations on the XRP ledger will enhance speed, security, and interoperability, making it easier for businesses to integrate XRP into their operations. Third, global macroeconomic trends, including interest rate adjustments, currency fluctuations, and geopolitical risks, will continue to drive demand for uncorrelated, scalable assets like XRP. For investors thinking about the next 5-10 years, the key takeaway is that XRP is not just a token, it's a strategic asset in the emerging digital financial system. Its limited supply, growing adoption, integration with banks and fintechs, and role in cross-border settlements position it uniquely compared to other cryptocurrencies. While Bitcoin may dominate as a store of value, XRP offers practical utility and network effects that make it indispensable for global payments. Finally, let's talk about timing and strategy. The market will always have volatility, corrections, and short-term dips, but as we've seen, the broader trend is clear. Institutional adoption is growing, real-world use cases are expanding, and the infrastructure is solid. For anyone looking to participate in this revolution, the most important steps are education, patience, and strategic allocation. Don't chase hype. Focus on understanding how XRP fits into the larger financial ecosystem, how institutions are using it, and how supply and demand dynamics could shape price over the long term. In conclusion, we're at a pivotal moment in digital finance. XRP is no longer just a speculative token. It's part of a new global infrastructure for money, value transfer, and digital liquidity. The combination of scarcity, adoption, utility, and macroeconomic tailwinds creates a compelling narrative for investors who want exposure to digital assets with strategic purpose. As we move forward, keep an eye on institutional participation, technological innovations, and macroeconomic trends. These will determine not only XRP's value, but also the future of the global financial system.